America doesn't need to print money to create wealth. It just needs you to believe it did. Behind every trillion-dollar spending bill, a silent machine transforms debt into rising markets, booming assets, and the illusion of endless prosperity. No cash floods the streets. No alarms sound. Yet balance sheets swell, valuations climb, and confidence becomes the most valuable currency in the world. But what happens when the system that manufactures wealth is powered not by production, but by perpetual borrowing? Because the real story isn't how America prints money. It's how it prints the perception of wealth, and who ultimately pays when that perception shifts. The most powerful financial illusion in modern history did not begin with a printing press. It began in a quiet Treasury auction room in Washington, where Secretary Daniel Whitmore authorized another $1 trillion in federal spending. There were no cargo planes carrying stacks of fresh bills, no dramatic announcement of currency expansion. Yet within days, markets surged, contractors expanded payrolls, and investment firms reported renewed optimism. To the public, it appeared as though wealth had materialized without cost, as if prosperity had been summoned through policy alone. What unfolded behind the scenes was more subtle. The U.S. Treasury issued new bonds to finance the deficit. Primary dealers absorbed the supply, confident that liquidity would remain abundant. The Federal Reserve, without printing visible cash, ensured orderly conditions through its balance sheet tools. Banks recorded treasuries as pristine assets, strengthening their collateral base. Pension funds adjusted allocations. As demand stabilized, asset prices climbed, and balance sheets across the financial system swelled quietly. No new paper money flooded the streets. Instead, digital ledgers expanded, credit conditions eased, and confidence amplified valuations. The economy looked richer, stronger, more resilient. Yet beneath the surface, leverage deepened invisibly. Because this was not traditional money printing. It was the engineering of perceived wealth through sovereign debt. And that architecture, once stretched too far, does not warn before it begins to strain. The secret was not hidden in vaults or secret meetings. It was embedded in the structure of modern money itself. In a glass tower overlooking Manhattan, portfolio manager Evelyn Carter reviewed her allocations, and to her, U.S. Treasuries were not burdensome liabilities, issued by a government running deficits. They were pristine collateral, the cleanest asset in global finance, the bedrock upon which trillions in transactions quietly depended. That single perception transformed debt into something that behaved like wealth. When the government issued bonds to finance spending, those securities did not sit idle. Banks recorded them as high-quality assets on their balance sheets, strengthening capital positions and expanding lending capacity. Using treasuries as collateral, institutions extended new credit into housing markets, equities, and private investment vehicles. As liquidity spread, asset prices responded upward, reinforcing confidence. Rising valuations improved household net worth, boosted corporate balance sheets, and fed the narrative of expansion. The cycle appeared self-sustaining, almost elegant in its design. Crucially, none of this required visible money printing. The Federal Reserve maintained orderly markets and stable funding conditions, allowing the Treasury market to function as the engine of global liquidity. As long as domestic and foreign demand absorbed new issuance, the structure held firm. But confidence is not a permanent resource. The same collateral that builds prosperity can, under doubt, transmit stress through the entire system with unsettling speed. At the dawn of the 20th century, financier Charles Kensington structured vast portfolios around the assumption that British sovereign debt was not merely secure, but eternal. The empire's reach across continents reinforced the belief that its liabilities were backed by limitless power and trade dominance. Then came the First World War, and with it a mountain of obligations. Britain emerged victorious but financially strained, burdened with massive war debt, declining industrial competitiveness, growing American economic influence, and an imperial system stretched across too many fronts. Rather than retreat, policymakers chose extension. They refinanced. They borrowed further. They leaned on global trust in sterling and the deep liquidity of London's markets. For a time, the illusion held. Asset values stabilized, investors remained confident, and the pound appeared resilient. Yet beneath the surface, economic output struggled to justify the swelling liabilities. Growth lagged while debt compounded quietly. When global pressures intensified in the 1930s, confidence fractured. Britain abandoned the gold standard. A structural pattern had revealed itself, one that would echo decades later across the Atlantic. In 1971, President Richard Halbrook confronted a quiet but dangerous imbalance. Too many dollars circulating beyond American borders, and insufficient gold to honor redemption promises. The decision to close the gold window marked the end of a metallic anchor that had defined monetary credibility for decades. Observers predicted instability, perhaps even decline. Instead, the United States executed one of the most sophisticated monetary reinventions in modern history. Freed from gold constraints, the dollar transitioned from being backed by metal to being backed by institutional trust and geopolitical leverage. Oil transactions were structured globally in dollars, ensuring constant international demand. Treasury markets expanded in depth and liquidity, becoming the central reservoir of global reserves. Foreign central banks accumulated U.S. debt not reluctantly, but strategically, integrating American securities into the core of their financial systems. Meanwhile, Wall Street accelerated financial innovation, transforming debt into tradable instruments that circulated worldwide. Debt issuance rose sharply, allowing the United States to finance military reach, implement tax adjustments, and sustain powerful equity bull markets without visible monetary breakdown. The architecture appeared self-reinforcing, almost invincible. But monetary systems built on confidence do not face pressure gradually. They encounter moments of testing. The unresolved question is whether continued expansion strengthens the structure or quietly stretches it toward an unseen threshold. Today, the scale of the system is no longer subtle. Federal debt has surged past $34 trillion, and interest payments are climbing at a pace that rivals major spending categories. Treasury issuance continues at historic levels, absorbing capital from across the globe. On paper, the expansion appears breathtaking, yet markets project calm. Equity indices hover near record highs. Home prices remain elevated despite tighter credit conditions. Unemployment stays comparatively low. And Treasury yield volatility, though sharp at times, continues to find buyers. From his office overlooking Chicago's financial district, analyst Marcus Holloway studies this paradox with disciplined concern. He observes that the mechanism forged decades earlier is still functioning. Banks treat treasuries as foundational assets, reinforcing collateral chains throughout the financial system. Foreign institutions, while adjusting allocations at the margins, continue to participate in auctions. The Federal Reserve intervenes when liquidity strains surface, preserving orderly market structure. However, subtle fractures are emerging beneath the resilience. Higher interest rates amplify servicing costs, placing quiet pressure on fiscal flexibility. Some foreign reserve managers are diversifying incrementally. Structural deficits show little inclination toward contraction. The illusion of stability persists, but it now depends on ever larger debt absorption without triggering destabilizing yield spikes. Late-stage sovereign cycles often look strongest just before recalibration begins. Nothing appears visibly broken. Yet history suggests the first signal rarely comes from headlines. It comes from the bond market's shifting tone. As the system stretches further into historic scale, three realistic paths begin to define the horizon. None promise immediate collapse, yet none guarantee perpetual stability. The first path is controlled normalization, a disciplined environment where economic growth gradually outpaces debt expansion, inflation remains contained, and Treasury demand stabilizes without extraordinary intervention. In this scenario, policymakers manage deficits with restraint, markets recalibrate smoothly, and confidence remains intact. It is the most elegant outcome, though it requires fiscal discipline and political cohesion, rarely sustained during late cycle expansions. The second path is financial repression, a quieter adjustment that unfolds without dramatic headlines. Interest rates remain structurally below inflation for extended periods, subtly transferring purchasing power from savers to borrowers. Asset prices continue climbing, nominal wealth expands, but real returns compress beneath the surface. The illusion persists, yet redistribution occurs invisibly through the mechanics of policy. The third path is structural adjustment. Yield volatility intensifies. Debt saturation concerns surface more openly, and policy architects explore modifications to the monetary framework itself. Great powers historically do not implode overnight. They evolve under pressure. Wealth does not vanish, it reallocates. For decades, the United States transformed debt into collateral, collateral into credit, and credit into asset appreciation. The structure remains operational, but its scale is unprecedented. When systems reach such magnitude, even modest shifts can echo widely. The unanswered question is not whether adjustment will come, but how deliberately it will unfold. For decades, the United States mastered a financial art form no empire before it had perfected at this scale. It learned how to transform government, debt into global collateral, collateral into expanding credit, and expanding credit into rising asset values. The result was not chaos, but confidence. Not visible money printing, but balance sheet expansion sophisticated enough to feel like organic growth. To the average American household, prosperity appeared to emerge naturally. Retirement accounts grew. Home values climbed. Markets recovered faster each cycle. The system did not look reckless. It looked resilient. But every system built on confidence carries a hidden threshold. The illusion works as long as demand for the debt remains unquestioned, as long as markets treat Treasury securities as flawless anchors rather than growing obligations. The risk is not sudden collapse. It is gradual recalibration, a world where higher rates, shifting reserve preferences, or fiscal fatigue begin to tighten the margins quietly. Empires rarely fall because they print too much money. They transition when the cost of sustaining the illusion exceeds the benefit of maintaining it. The United States still holds immense structural advantages: deep markets, global liquidity networks, institutional power. The question is whether those strengths will fund another reinvention, or simply extend the current cycle a little longer. Because in the end, wealth created through debt is never free. It is deferred. And deferred costs always arrive, just not always where people expect. If this story challenged how you see money, debt, and American power, don't let it sit quietly in your watch history. Send it to someone who still believes prosperity only comes from printing presses, not balance sheets. The real edge in this economy doesn't belong to the loudest voice. It belongs to the most informed circle. Build yours wisely. And stay connected here, as we dissect the systems others oversimplify. Because the next shift in global wealth won't be announced politely. It will reward those already paying attention. Now, here's the real question: which country are you watching from? And do you think your nation could run the same debt illusion America does?